Today, we are breaking down the critical distinctions between immediate and deferred annuities for the national portion of the life insurance exam. You will encounter questions that test your ability to distinguish these products based strictly on the timing of the first income payment and the presence or absence of an accumulation period. An immediate annuity, often referred to as a single premium immediate annuity, or SPIA, is characterized by one primary factor, which is that income payments must begin within 1 year of the date of purchase. On the exam, if you see a scenario where a client provides a lump sum today and starts receiving monthly checks 30 days later, you are looking at an immediate annuity. The defining feature here is the lack of an accumulation phase. Because the money is converted into an income stream almost instantly, there is no time for the funds to grow or accumulate interest before the payout phase begins. You must remember that an immediate annuity is always funded with a single premium because you cannot start an immediate income stream without having the full principal already in the hands of the insurance company. In contrast, a deferred annuity is designed for the long term. Income payments are delayed for at least 1 year and often for several decades. This creates two distinct phases that the exam will frequently ask about, which are the accumulation phase and the annuitization or payout phase. During the accumulation phase, the owner makes premium payments and the account earns interest on a tax-deferred basis. This is where the exam might try to trick you. They will ask if a deferred annuity must be funded with periodic payments. The answer is no. A client can buy a single premium deferred annuity, or SPDA, by making one large payment and then letting it sit for 20 years before taking income. Do not confuse the method of funding with the timing of the payout. If the payout starts more than 12 months from the purchase date, it is always a deferred annuity, regardless of whether it was funded with one check or 1,000 monthly checks. A common exam trap involves the surrender charge. Surrender charges are almost exclusively associated with the accumulation phase of a deferred annuity. If a policyholder tries to withdraw funds during the accumulation period, the insurer assesses a penalty. You will rarely see surrender charges discussed in the context of an immediate annuity, because the contract has already been annuitized and the funds are already being paid out. Another trick is the timing of the first payment. The exam might state a client buys an annuity on January 1st and wants their first check on December 1st of the same year. Because this is within the 12-month window, it is an immediate annuity. If that first check is scheduled for January 2nd of the following year, it has officially crossed the threshold into a deferred annuity. To remember this for the exam, use the phrase "immediate is for now" and "deferred is for later." Think of the letter I in immediate standing for income starting soon, and the letter D in deferred standing for delay the payout. On your test, look for keywords like benefit payment period and accumulation period. If the question mentions an accumulation period, it is always a deferred annuity. If it says the client is seeking a current income stream from a lump sum, it is an immediate annuity. Understanding that the primary difference is purely the timing of the first payment will help you navigate these questions quickly. Many students get hung up on the tax benefits, but both offer tax-deferred growth during the accumulation phase if applicable. However, the immediate annuity effectively skips that phase entirely by jumping straight into the liquidation of the principal and interest. Focus on that 12-month cutoff as your definitive marker for choosing the right answer every time. When a question mentions a retiree who needs money to pay monthly bills immediately following the sale of a business or home, look for the SPIA option. When the question mentions a younger worker saving for the future, look for the deferred option. Pay close attention to the wording regarding when the first payment is due, as that is the ultimate decider between these two classifications on your national exam.